Yeah, hit him, man.
Clap once if you can hear me. Clap twice if you can hear me. And then 3 times for fun. All right, cool. We know how to clap. Thank you, everyone, for being here, for attending the 8th annual Startup Boston Week. My name is Mohammed. I was telling earlier the last group that that's not a common name, but as you know. But I'll be your host today. And a huge thank you again to Suffolk University's Sawyer Business School for hosting this conference. As you have noticed, this downtown location is the perfect hub for exploring Boston's innovation ecosystem and learning from industry leaders. So the goal behind Startup Boston is to connect the entire Boston, greater Boston area, and also New England. So I'm from Maine, and look at me, I'm here to connect with you guys. All industries, all startup departments, and all bootstrapped and funding stages for 5 days of learning and connecting with one another. The team that creates Startup Boston Week is primarily volunteer, and folks working the conference today here are volunteering their time as well. So thank you for attending this conference. It is a labor of love, and we appreciate you playing a role in shaping our startup community. So we have Ross, our moderator, who will be introducing the other players on the field. So yeah, take it here from Ross, and thank you again. Please be engaged. And also, there's plenty of seats up front, besides one seat that's mine and reserved. So come up, please. Thank you.
These are live. Hello. Coming through? That's coming through, right? All right. Great to have you all here. My name is Ross Pally. I am the Director of Business Development at the Massachusetts Clean Energy Center. And in terms of background, I think I've run or been a part of 6, possibly 7 startup accelerators over the last 8 years or so. So I think I've actually done, I did the math at one point, I think I've done my 10,000 hours of supporting early stage founders of all, thank you very much, of all technologies and industries. So good breadth of seeing so many different startups there. We are going to introduce our illustrious panelists. To my left, we have Steve Dow, co-founder or founder and CEO of Monit. And Steve will ask you for a bit of background, a bit about Monit, and maybe the biggest way that valuations come into your professional life in the present day.
Whoa, I'm gonna head right in.
Or just the first 2 of the 3.
Okay. Is this working? Good. Yeah, so Steve Dow with Monit. So Monit, we're a fintech software firm selling a platform to banks. We help banks serve their small business customers more effectively. And so I was a former banker, and we said, hey, listen, small business owners are entrepreneurs pursuing their passion, probably like many of the folks in the room. And they don't tend to be financially, sort of trained or savvy, and a lot of small businesses, mostly sort of Main Street businesses, tend to get themselves into trouble as it relates to their finances. So we want to provide better tools so business owners could understand their finances and make better financial decisions. We chose to distribute those tools through banks and credit unions because it was our belief that banks and credit unions should be helping these businesses understand their finances. We also have an aspect of our platform. By the data that we get on these small business owners, we can help the banks serve those customers more effectively. So that's what we do. I might save my valuation commentary for later.
All good, all good. Round of applause for Steve. And we also have Ashley Eknan. Nailed the pronunciation.
Nailed it.
Nailed it. Spent a full 5 minutes talking about pronunciation of last names before the panel. Chief Digital Officer of Eastern Bank. Ashley, welcome. Maybe a quick couple of words about your background and what you're up to at Eastern Bank.
Sure. So Eastern Bank is a full-service regional bank headquartered here in Boston. We're about $27 billion, I think, in assets. I'm the Chief Digital Officer there, so I run Eastern Labs, which is sort of our internal fintech incubator. So I get to work with awesome companies like Steve and Monit, and the original research. We do a ton of research in Eastern Labs. So the original sort of research for Monit kind of came out of Eastern, and we partnered with Monit on that. And then I'm also in charge of running sort of our online and mobile platforms and project management and tech financial performance. So a wide variety of things over at Eastern.
That's all?
That's all.
That's all. Oh my gosh. All right. So this might be a little bit of a non-traditional approach here for this panel. We are going to start with a little bit of polling the room, just so all of us up on stage have a better idea of who we're speaking to and how we should tailor this content about valuations. So if you would oblige, please raise your hand if you are currently a startup founder. Great, exactly what we were hoping and expecting. Raise your hand if you're not a startup founder. Keep them raised if you are an aspiring startup founder. Okay, if you just put your hand down, shout it out. What are you here for? Who are you? What do you do?
To connect. I'll start.
To connect. Thank you, Mo. All right, shy group. All right, so we're talking about mostly founders. For all the founders in the room, raise your hand if you are a software-only business. Wow, raise your hand if you have some kind of hardware, material science, something of the like. Okay, so raise your hand if you're a mix of software and something else. Okay, great. If you are a startup founder, raise your hand if you are a pre-revenue company. All right, raise your hand if you're post-revenue, but it's sub-million in revenues a year. Okay, raise your hand if you are later stage and all of those things that we just kind of talked about. All right, early stage group, founder heavy group, that's great. That's exactly what we were hoping for. So, another non-traditional approach. We are going to go right to the audience with questions so that everything we talk about is stuff that you guys want answers to and stuff that you guys want to learn about. So, I know we have a shy group. If we completely fall flat on this part of the session, then we'll just go right to panelist discussion. But does anyone have questions about valuations that they would love to have answered in the next 45 minutes? Thank you. Yes.
Full pause for founders as they look at setting up their companies and future valuations.
Yep. Thank you so much. Thank you for the bravery and the courage. Do we have other brave and courageous founders in the room? Yes, in the back.
How is the market looking now versus, say, 6 years ago?
Great. Let's just keep going. I'm writing down as fast as I can.
Quick one from the back. How are you seeing the election either accelerating or decelerating various investments in different areas?
Thank you. Let's do a few more. Keep it
Around the
going.
market trends, are there any resources where people aggregate information of current trends, even across different industries, so you can kind of know, like, ballpark what the expectation should be, pre-seed, seed, Series A, et cetera?
So I missed the very first part.
Are there any resources where people, like, aggregate this information, be, like, publicly available, or is it all just you have to kind of ask your friends if they're lucky enough to share it? I don't know.
Great. Thank you.
How much does it benefit you to follow the trends? So, like, the word on the street is if you have AI anywhere in your in your idea, then you can get money right now. I'm just curious how much that's true.
Great question.
Yeah, pros and cons to doing a pre-seed round. And if you can bootstrap through the pre-seed round, is it better to do that? What are the risks?
Great question.
What are the factors you'd consider in valuing a hardware startup where you've just got a prototype and a couple of patents
Yep.
and you know the market size?
All right, maybe. All right, still going. Raise your hand if you think you're going to ask a question in the next 60 seconds or so. Maybe with two. Okay, we'll wrap up with these two, and then we'll go on discussion. And then we have a whole hour block here, so I think we might even have time to answer questions that folks think of in the next 45 minutes or so. So over in the back.
Yep, just back to bootstrapping. Bootstrapping versus other methods with a software-heavy, product-heavy. Like if you could crank out the product, bootstrapping vis-a-vis other options.
Yep.
And how do you evaluate a startup that is not venture scalable?
Great. Start. Okay. All right, our poor panelists, they thought they'd be talking today. And they have not had any opportunities yet, but we're going to them right now. Steve, Ashley, any of those questions jump out to you as ones that you want to answer right away? And if not, I'll quarterback the Q&A from here on out.
I have one more screener question. Are there any VCs in the room? All right, so we'll have to moderate our honesty a little bit here, but good to know. Thank you, guys.
All right, so let's go ahead and start with the very first question. Good starting point. Faux pas of setting up your company from a valuation standpoint. What are the things you definitely shouldn't do as it pertains to a valuation that might have adverse effects on my company's future? Anything come to mind, Steve or Ashley?
I'll go. Well, I think one thing from just, my perspective, I'm not a professional investor, just want to make sure everybody knows that, right? I work for a bank and, we sometimes, do limited investments. However, what I've seen from the startups that we do work with is, my industry, banking, fintech, it's not a monolith, right? There are different subsectors within that industry, right? There's banking infrastructure, there's payments, for example. And startups within those subsectors might have different multiples or different sort of market growth trajectories. So I think understanding your industry and are there subsectors within your industry and are you sort of tagging yourself against other people or other companies in your correct subsector. Again, someone that has AIs and payments might be, looked at, approached very differently than someone who is, has maybe like a fraud or compliance or a regulatory solution. Not that I don't love my compliance and regulatory friends, if anyone is listening right now, but that's something to kind of keep in mind. Just a subsector. Like, are you sort of thinking about yourself with the right competitive set? Comps
are helpful in valuing so many different companies and assets of all kinds, and it certainly applies here.
Right.
Great. Steve?
Yeah, I think on faux pas, and so we should also be clear about our perspectives here. So we sell to enterprises, we sell to banks. Ashley is an enterprise buyer. It sounds like there's some folks in the room who may not be on the enterprise side, so those answers might be different. Coming from someone who started a company who was selling to enterprises, one of the mistakes we made early on was outsourcing dev, and I've talked to other founders about this, and I think this is a common mistake. It is attractive to do that. You can get access to a team. You don't have to hire all these folks. You can theoretically go faster, but you're going to spend a little bit of money. The expense side can be managed, but that's also a consideration. I think the reason I would call it a faux pas for us was we spent a fair amount of money. We built a product that once we finally hired an internal team, they had to refactor a fair amount of it, and that ultimately led to implications on our valuation because we spent all this money and then basically had to sort of spend another amount to kind of redo things. So that'd be the biggest learning from us. As you think about building the company longer term, some of the things that you can do right or wrong early, outsourcing dev, I would take that decision and think long and hard about what you're getting out of it and what that may mean for you down the road.
Yeah. Further on in that point, other key considerations for outsourcing dev work. What do you build versus what do you buy? Steve, Ashley, correct me if some of these guiding principles are contrary to anything that you've heard, but if there's anything in your tech stack that is table stakes, so you are going to build a chair and compete in the chair provider or manufacturer market, maybe there are plenty of vendors out there that can build legs and build seat cushions, but your chair is competitive because it's got a back to it that no one has ever thought of, and that's your secret sauce. Then maybe you outsource the things that are quote unquote table stakes, the legs and the cushions. And if there's something that is super proprietary to your business and core to the value proposition that you're delivering to the market that you're serving, that is the stuff that you absolutely build and do not buy. Steve, Ashley, ever heard anything different, or does that kind of check out?
Yeah, the other thing I'd add to that is, so we, despite what I just said a minute ago, we do have some contractors now. And kind of the guiding principle we have there is we don't want them to think. If they're thinking about the product, if they're, kind of doing stuff, we want to set the pattern and say, this is our structure. We need things to work this way, and they can effectively build according to that. I think that's a good principle. If you're, like letting someone invent the chair back or whatever it is, that's ripe for some issues. So that's the only thing I would sort of add to that.
So in terms of faux pas, what we have talked about thus far, outsourcing too early, probably going outside of your kind of like your comp pattern within your peer group. We did not yet touch on specifically any faux pas that can be made when you're setting a valuation on your company for the first time. Maybe it's not a valuation on a seed or a Series A price round. Maybe it's a cap in the first safe note that you put together. When it comes specifically to valuations, any faux pas that you would warn all of our founder friends against, or if that's a later stage conversation, we'll save it for a different question.
Yeah, I mean, this is a long answer. So setting your first valuation. So I think my starting point here is, especially for early stage folks, which sounds like it's most of the folks in the room, valuation's bullshit. And let me sort of go into that a little bit more, because I mean,
before he goes into it, he's right. Which is why we did the polling of the room in the first place before we even got to the conversation. Our collective hunch here was we're going to have a very early stage founder group, and valuations are a very different point of conversation if we were a room full of Series B plus founders, where there's 8 different methods of setting a valuation for a startup and immense consequences if it's too high, too low. This is a very different consideration if you are pre-seed or pre-revenue or raising on safes and it's not a price round. And we'll get into all of the reasons why it's a very different conversation if you're in the early stage bucket. Sorry, that was a quick explainer. Back to Steve for the rest of that answer.
Yeah, no, I mean, so if you think about valuation in general, so as Ross is saying, the further up you go market, valuation becomes clear, right? So public markets, any of us can look on our phone and see the valuation of GE is today. That's very clear, very liquid. As you go down the scale, it gets murkier and murkier. I think, post-revenue, there's some metrics, and our VC friends have models for all that. But as you get sort of further down, I mean, you've heard all this before. It's the team, it's the market size, it's, how unique is your thing? Does it have AI attached to it or not? Right? Like, there's all that kind of stuff that's a consideration, and there's lots of points of view, and it's ultimately a point of view. And a good example of that is just look at the last few years, right? Valuations were, sort of quote unquote normal in 2019, and they got crazy in 21, 22, and now we're corrected or whatever, right? Like there's no fundamentals to that. It's all about point of view, market demand. Right now, there's more demand than there's supply, so that sort of moves things around. So understanding all that, I think, is really important as you think about valuation. So when you set your valuation, it's going to be a function of all those things, and you can be lucky to choose your valuation in 2021. Or you can be unlucky to choose your valuation in 2023. Tough shit, either way. Like it's like you just are where you are. And so now there's things you can kind of do to, if you're in 2023, there's some things you can do to help yourself. But be aware that there's no sort of straightforward way to get to your valuation. It really is about, I said earlier on, it's telling your story, understanding the market, all that kind of stuff. But it's really about that. And it's also, and this sort of gets into another part of the conversation down the road, but it's really about the investors that you're pairing up with. And we're going to talk about process at some point around, sort of engaging with investors, talking to them over time, getting their take on these things. So they all have different points of view on this too. And I think you need to find like-minded folks as it relates to this and get their take. Like part of the process discussion is talking to investors early on and say, how do you think about valuation? Like what are the things that are important to you? Because they're the ultimate, right? You're selling equity, they're buying it. So you want to understand what your buyer, what their point of view is on something that is totally amorphous and totally hard to pin down.
Yeah, I really like what you said there, Steve, because it's like a question costs nothing. So,
Yeah.
You should just ask as many questions, right, of your potential investors as possible. And I think you bring up a good point is understanding where you are in the cycle, right? Again, investing or raising money in 2021, very different than raising money in 2023. And are you sort of better off maybe in a sort of tight cycle, right, or in a downturn? Are you better off sort of raising less, holding on, and then, having a better round later on? It just is, timing is everything, as it is mostly in life, right?
Totally.
Yeah, and speaking of timing, we will move to one of the other questions from the audience. Market now versus 6 years ago. Maybe what's happened since? Because I know we all have amazing recall, and we can tell you exactly everything that's happened. I suppose the last 6 years, that brings us to 2018. We all know what happened in 2020, and I think things were looking pretty rosy leading up to 2020 when you talk about startup valuations and how public markets were looking. Steve, Ashley, any insights on where we were on a macroeconomic level around 2018 and maybe some key events and key changes in cycles since 2018?
Yeah, I mean, I've raised money in probably 4 of those 6 years. So, well, we started in 2019. I don't know what happened in 2018, but yeah. So I think and this is just one data point, so take it with a grain of salt. Sort of end of 2019 into 2020 was sort of normal-ish, right? And then COVID hit. We were going out to market, talking to a lot of these investors, and again, this sort of gets into the process stuff. Once COVID hit, we had investors telling us, hey, no one's going to make any investments in the next year. You need to have 18 months of cash run, which we, close to that. We had friends, family, kind of pitching in. And so like, if you don't have 18 months of runway in, March, April of 2020, you're screwed. Fast forward about 2 months later, and like the spigot's open. So you can't time these markets. Like, they just happen. Again, it's sort of a function of a lot of different things. And so, we ended up raising in 2021 our sort of seed round. And, we purposely, like, we thought about valuation pretty hard, and we saw what was kind of happening, and we took what we thought was a pretty normal, kind of middle of the road type valuation. And our lead investor was someone who I'd known for a long time, and we had a very similar point of view on this, that the market suggested we could have gone higher, but we chose not to, which is sort of a novel thing to do. And then, we've raised money since and sort of seen the fluctuations. I think now, it's sort of, it's a mixed bag. I talk to our current investors and prospective investors all the time. It's sort of a mixed bag. It sounds like things are quote unquote corrected, but I guess, the last few months have been a little bit slow. Someone brought up the election. I think there's just, anytime there's uncertainty, that tends to slow things down a little bit. It seems like things are coming back a little bit. We did a round this year and it was oversubscribed, right? So, it's sort of hard to tell. It's a little bit company specific, but it seems like we've had some ups and downs, and there's some level of normalization, whatever that means. I don't know if that's helpful or not. That's my experience over the last 5 years.
Yeah. And just from like a fintech industry perspective, like F Prime does this great fintech index chart, if you find it, and it's like meteoric rise, right, of fintech startups. Sort of 18, 19, 20, 21, and then there's this peak, and then there's just this complete market correction, and then sort of the stabilization, and then, to your point, starting to come back a little bit. But in those years, like of the meteoric rise, I just remember, it's now AI, but it was everything, like all things crypto. And that was really kind of interesting to see. Like all of a sudden, you know, you get like Tom Brady hawking crypto on like the Super Bowl, and you're like, oh my God, there's a bubble. And it's just really, it's really interesting to see, right? Like when you're in an industry and you sort of, you know, you've been dealing with things, you're kind of seeing those trends, and then to see them pop like that, really fascinating. But I think, again, it just sort of AI seems to be the new kid on the block. We'll see. That seems to have sort of more legs. You see sort of crypto, you know, was all of a sudden, you know, the belle of the ball kind of went down. Now it's sort of coming back with different use cases, or people are more focused on the technology behind it. So it's sort of it all works itself out over time.
So as a follow-up to that, Ashley, we did have a question from the audience. Should we care about trends? If we should care, how much should we care? You've kind of answered it, but any more thoughts?
Maybe like not care is the word, maybe aware. I think you want to be aware of the trends and aware of what's out there. And I know we're picking on AI comment a lot, but it's a good one, because it's like, you know, you see, you know, I see startups kind of be like, we have AI. Be like, okay, like AI's been around for a long time, right? Like, do you have generative AI? Are you using machine learning, right? Like, are using RPA, very, very different types of, you know, quote unquote AI. And that's okay, but like, you know, what are you using it for? Marketing purposes, to get sort of the buzz out there, and where that's gonna take us. So I think you do need to be aware, whether it's from a macroeconomic perspective or an industry trends perspective, kind of aware of what's happening, and whether that's an economic trend, that could be customer behavior, right? You know, obviously, like if you're in the travel industry, right, you care about things like, you know, COVID, or like health, or consumer confidence, right? For example, consumer confidence index, tracking that, because, you know, do people feel safe with their current income levels, and that to book that trip? So I think it's important that you're sort of aware of sort of what's happening in your industry and the broader sort of economy or marketplace.
Speaking of consumer confidence, very important question that we did not ask when we were polling the group. If you are a founder, raise your hand if you're B2B, you're selling to other businesses. And raise your hand if you're selling to consumers, B2C. Okay, so there's a difference too. if you're selling to consumers, a lot of what Ashley just said, consumer confidence, very, very critical. Extra macro factors for you to consider versus maybe a B2B company of some kind.
Yeah, like B2B comment is great. Like, you know, startups that are selling to Eastern, right? Like our sales cycle is longer, right? We have to get through a lot of regulatory checks. We care a lot about cybersecurity, right? That's going to take longer, right? From a B2B, like even a sales cycle perspective in different industries. I'm sure those startups in healthcare face the same, you know, sort of challenges with just a longer sales cycle when you're B2B.
Absolutely. Steve, to return to something that you said during your raise story thus far, at one point you could have raised at a higher valuation. You maybe had some folks around you kind of tried to nudge in that direction, and you made the decision not to. Possible to unpack that a little bit for us? Why not raise at that higher valuation that maybe some folks thought you ought to? Because I think that's probably one of the key faux pas, to go back to the very first question of the day, that it would be helpful for us to cover for folks in the room.
Yeah, I mean, it's a relatively straightforward story. So actually, Ashley mentions the F1 kind of index, or some other ones. Somebody asked about resources like TechCrunch, CB Insights. There's a few of them out there. You can kind of see some of these trends. And at the time, like the historical data, we can kind of see seed stage companies had a valuation of, I can't remember what it was, X. But the markets were starting to turn sort of frothy. You know, there were certainly anecdotes and some data points that, you know, people were getting a lot higher valuations. And we just, so again, it's appealing to say, oh, our company's worth, you know, 5 times X. Like, who wouldn't want to think that? But you know, you have to grow into that valuation at some point, and so it has to be reasonable. And so we said, hey, listen, we have a good sense of what this is worth. Again, back to the, like, valuations a little bit BS or whatever. You got to set a mark, and we felt comfortable kind of going with the kind of historical average at the time. it just felt better, and it has allowed us to, sort of increment on top of that, as opposed to like taking these down rounds and doing these other things that are a little bit more painful. And so I think having some humility up front, and reasonability, whatever do you want to call it, and sort of, recognizing that you're all just kind of making up a number, and then, trying to build off that. Because at the end of the day, like, people, I think, overweight that initial valuation because it does set a mark. That's fair. And so, but guess what? Building a high growth, sustainable business is a lot more important than whatever that first mark is. And so that should be your focus. And, coming to terms at some reasonable level on what that valuation, you probably shouldn't get overly sort of anxious about that. And that's sort of where we were. It's like, hey, listen, we know these are good investors. We know what we're doing. We believe in the product. We have a great team, all that sort of stuff. Let's just take a valuation that seems reasonable to us, as opposed to like reaching for the stars and then, having that overhang, sitting over us as we develop the company.
And just to add a little extra color on that point, it's a fairly clear pattern that I've observed, at least supporting so many founders over the last several years. It tends to be the younger demographic of founders, not to be too ageist in this point. It tends to be the younger demographic of founders, and more so a lot of the first-time founders, that the first time they're putting a cap on a safe for their company, or they're setting a valuation for their company of some kind, they're going for as high as possible. And there's a little bit of ego mixed in there. There's a little bit of trying to prove yourself. But if you watch the second and the third time founders do the same thing, by the same thing I mean setting a valuation on their company, there's a little bit more poise and maturity and forward thinking, and setting a valuation for their business that is sustainable. We won't go into all of the math that explains why raising a down round can be so detrimental to your business. Maybe just for the time being, take our word for it and then do some Googling after the panel. But that kind of discipline can be pretty important. All right, let's do a quick and easy one. The upcoming election. Let's talk politics. So easy. Upcoming election. From the standpoint of how an upcoming presidential election might affect macroeconomic factors, availability of capital, valuations, anything that the room should know, Steve or Ashley, when it comes to an upcoming presidential election.
I don't want to answer this question. I mean, Steve said it before. I think uncertainty, right? It's one side or the other, and I think there are implications either way. Like an example, just from a macroeconomic perspective, is that like Fed. Let's just take the Fed and interest rates. They probably won't move right before the election because they don't want to give off the impression of influencing the election. Right? Like uncertainty. So I think you have even, big organizations that are sort of saying like, okay, we're just gonna stay and not do anything because we don't want to influence either way.
Yeah, I don't have a lot to add. I think anytime there's uncertainty, markets don't like that. Venture markets aren't excluded from that. So, I think if you, and there's a premium associated with uncertainty. So I think if you can wait to do it after the election, I don't know if it'll matter one way or the other, but just everyone will know what the answer is, and then they will proceed accordingly. And so that's the only thing I would say is if you can wait to raise after, I probably would, because then everyone will know what the next 4 years looks like, or at least have a point of view on it.
In this case, way to raise, and you might be a startup founder who isn't in a position who can wait to raise. Ideally you are, but that just might not be the reality. I think one of the smartest things that a founder can say to a prospective investor when they are raising is, we've done the math, here's what we need for the next 18 to 24 months to hit the milestone that we plan to hit at the end of that 18 or 24 months. and we're going to raise a little bit more than that because Murphy's Law, like who knows what happens. Maybe it turns out that the 18 to 24 month mark, you're a few months or 6 months away from a presidential election, and you really didn't think about that and the consequences it would have for tightening capital availability. So for all those founders who are raising or might raise, I at least have always thought that it's a pretty aware approach to give your investors the numbers that you absolutely need, and say we are consciously adding a little bit of a buffer for ourselves because who knows what might happen in those next 18 to 24 months. None of us has a crystal ball. I'm going to take one of the questions from the audience just because I feel like for me, a chunk of my professional career was working with software startups and founders. And more recently, over the last 8 months or so, it's been a lot more hardware, material sciences, things that are not software. And we had a question, how do you value that kind of stuff? I would say it's really for early stages. Again, we're talking, this is like a full 100% early stage kind of conversation. Whether you're software, whether you're hardware, whether you're something else, if you're still a pre-revenue company, a first revenues kind of company, back to the one of the very first points that Ashley made, comps. Look at 10 or 15 or 20 startups that are kind of like yours and what valuation they raised at when they were at your stage. And if you can't find that information, go talk to 10, 15 founders who are a step beyond where you are in terms of your company's life cycle and ask them. Because you really, at the early stages, if you go far outside the norm, that kind of comp band, it's a little bit of a question mark. If you say, no, we have an enormous addressable market, or we're doing something that's never been done, we're so novel, and you try to claim a valuation that's way above that band, back to one of Steve's points, you might be setting yourself up for a future down round, which will not serve you in the long run. So just to take the non-software question, comps is the simplest question answer I would give. Question in the back.
Hello.
Go for it.
Thank you. I'm Paul. I have a company called Grogistics. It's very stealth. I'm working on conversational stuff to help in-field assistance and doing that for small and medium-sized farms. And so farms like clean energy, they benefit, congratulations, from like subsidies and grants. So my question is, if you're dipping into that pool, if you have the luxury of doing anything like that, the subsidies and grants, does that affect and how does that affect and what should be considered about later on when you get to a valuation, like pre-revenue valuation? Yeah. Is that a legitimate question?
Absolutely. For a lot of this, and Paul, I apologize. I'm going to keep this answer super brief because it's a little more particular to a certain kind of company. And if we can, if you want to catch up after this, we can go on for a much longer time or open that opportunity to anyone in the room. Last 8 months, I have been working with companies that are just all that. Not necessarily, hey, agriculture or farms are our target market, but we are the sort of company that runs on grant money or other forms of non-dilutive for a year, 2 years, 3 years before we even thinking about raising equity funding and private capital. The short form of the answer is do that. Sorry, what was that? You do what you got to do. You do what you got to do. I would say this isn't going to be a direct answer to your question because I think you're asking more about like what consequences does that have for valuation? Let's talk about that one-on-one. I think the most important point to make is it's great if you can run on grants for a period of time. This is a hot take. This is one data point. Take it with a grain of salt in collection with many other data points. if running on grants for a significant period of time makes you more of a project-based kind of company, where, hey, we raised a big DOE grant or EPA grant to do X, Y, Z, and now you spend 12 to 18 months standing up that project. It's a demo site in this part of the country, and now we like grant land. We're going to stay in grant land, so we actually raised another big grant to stand up another project. That's fine if your vision and your ambition and your management team and your advisors and your employees are all aligned with that vision of we're going to be a little bit more of a project-based company. We're going to hop from installation to installation. If the collective vision is more along the lines of the venture back, the high growth, we want to be a very large company and make a very large impact on the world that way, don't stay in grant land longer than you have to, and go to the private markets and get some private investor dollars. There's a lot of reasons why, and as I said, we can catch up one-on-one and unpack that fully. Any other questions from the audience that have come up for folks as we've been chatting? Not so much. All pretty clear. All right, then we will go.
Can I ask a question to you and Steve?
Yeah, absolutely.
Yes, I'm turning the tables on you, moderator. Because I think you guys have brought up some really good points from different questions on like, how important is community? Like having a community of other founders. We're at Startup Week Boston. It's this amazing sort of conference where different founders, you have different sessions, like it's all education, it's meeting different people. Someone said to connect, which is great. Like how important is it to talk with sort of other founders that are at your stage, that have done it before, right? That you kind of have this network of people you can ask questions to. Like,
So
how important is that?
I've got an answer, but I've been talking for a while, so Steve, or if not, I can go.
Yeah, no, it's hugely important. I think, starting a company is lonely. Running a company is lonely. And so to the extent you can connect with folks who are going through the same problems, it's incredibly helpful. And there's a lot of different places to look. This event is certainly one of them. And there's some places in town, folks who are local. Ross used to be at a place called Venture Lane, which is where I now we have our office, and it's a co-working space, but they do a lot of programming. So like they'll have a lunch for CEOs. CEOs kind of sit down and just, sort of chat about things, which is incredibly helpful. CIC has some other stuff. There's a lot of these organizations, so just find one or two and attach yourself to it. Investors is another good route to go, right? So they have all these portfolio companies. They talk to lots of companies. And so if it's, if you've taken investment from an investor, asking, hey, I noticed, other portfolio companies kind of like us, can I talk to their founder? That's usually a good way to go, and you can convince about the investor. And so there's a few different ways to do it, but I would definitely look into that. It is incredibly helpful.
Echo Steve's point about connecting with other founders in the portfolio. I will also add that when it comes to founder communities and the value of founder communities, I have been tasked with building many of these. I would differentiate between, if you are a first-time founder, I would differentiate between a community of other first-time founders and making connections and relationships with founders who this isn't their first go around. Because I think the value to be gained from those two groups is quite different. The first, it is very important. We used to, at Venture Lane, which Steve mentioned, we used to run CEO circles. And those were one of the most, of everything that we put out there, resources for founders, that was one of the most beloved things that we did. So I will put it to every founder in this room, if you are not a part of a CEO circle or peer group of some kind, I can't encourage it enough. And kind of the rules of the road for us in those groups was, there are things as a founder, a CEO, that you can't possibly talk about with your partner, your other members of the family, your friends, your employees. There are topics of conversation that you wouldn't broach necessarily with the rest of the team. And there is no one who's going to understand those things other than another startup founder. Peer groups are generally stronger if the role that everyone in that peer group is in is really effing hard and really unique. There isn't quite any other role like it, which if you're a startup founder, you can check the box on both of those things. So community of first-time founders, I would get into a peer group if you can. And if you can't find one, I would start one. And if you want some tips on kind of, good rules of the road and guidelines on how to facilitate those things and keep them going and keep them strong, happy to share those too. But also connecting with founders who have done this two times, 3 times more, I'd say that's probably pretty invaluable. There are lessons learned that you just aren't going to learn unless you've done it before. So that's probably true in any facet of life. Go and seek out folks who have done what you're trying to do. So great question, Ashley, about founder communities and community in general. Let's try to get to our friend Mo. How are we doing on time?
We have about 14 minutes.
14 minutes. Quick pulse check. Any questions from the group before we hit some of these questions that we haven't yet? Yes.
Talks about valuations, but thinking about us founders here, a lot of us very early stage. At one point, safes, everyone's using safes. Is that still trending? If you say you're looking for a seed round, is that still like very common? Are people starting to do more like equity rounds?
Instruments. Steve, Ashley, thoughts? Current state of
I
affairs.
think I've seen both.
Yeah.
But
I see both.
Yeah. So this sort of gets to the process stuff. And so when you're raising, especially for the first time, and I'm sure you folks have heard this before. I mean, you have to have a ton of investor communications and meetings. It's rare that you're going to talk to one VC and he or she's going to fund you. So you got to talk to a lot of investors, understand their points of view on these things, understand if they invest in your area. Like, are they, if you're health tech, like really? I mean, I have a cheat sheet. Every new investor I talk to, I ask them 6 or 7 same questions. What's your minimum ARR? What's your, there's all these things. You just need to kind of put all these investors into a box just for your own mental sanity. And so you'll quickly figure out who are sort of most promising and who are not. One of the things you should ask them is, how do you like to invest? How much flexibility do you have? Do you only do priced equity? Do you do safes, convertibles, all this sort of stuff? Understanding their preferences is important because a lot of them have strong preferences. Some will not touch a safe. That's fine. And you should have a point of view on whether you want to do a safe. We did safes. I think you should really understand the implications of a safe. They can be good and they can also hurt you. So the valuation discussion, it allows you to punt the valuation depending on how you structured it, but that's the primary purpose of a safe, which is a simple agreement for future equity for those who haven't looked at it. I would really understand those ins and outs, talk to an attorney who understands them. But they're a great tool for the right business at the right time. But some investors just aren't interested in safes, and some are. So that's a key question you need to ask during the process when you're talking to, all the investors that are out there. And I don't have there's no generic answer on should you use them or not. They're still very much being used. It used to be more of a West Coast thing, but now it's kind of everywhere. So I would definitely look into it, talk to your investors about them, and then figure out the terms that make sense to you.
Yep.
Thank you. My name is Mark Singh. I come a little bit late, so the question I asked might already been answered, but let me ask. I guess is the topic is about valuation, and my question is for a lot of people here running a startup, when they thought about this issue, in terms of the available resource, what is the top 3, for example, resource that you could recommend that I can use if I need to think about this issue from each of you? If you can share that resource, that would be wonderful. Thank you.
Absolutely. We did have the resources question, and we've shouted out a few so far. I was writing them down. F Prime resource. Ashley, do you want to quickly mention that one more time?
F Prime for fintech. They do a great sort of index, fintech index. And I think you mentioned CB Insights, TechCrunch.
Yeah.
Carta is another really good one. So Carta is a cap table management system, and they have, I don't know, tons of companies on their system, and they do reports. There's a guy who's pretty active on LinkedIn, but you can go to their website. They do reports periodically on trends at the seed round, trends at the A round. I can't remember the guy's name, but I follow him on LinkedIn, and he puts out some really good stuff that talks about trending in things like valuation. So Carta is another really good resource.
I know exactly the LinkedIn person that Steve is talking about. I also don't remember that person's name. But really, like, there's a lot of these platforms that are essentially the kind of Bloomberg for startups, these data repositories for early stage businesses, and they have access to all the data. So some of these insights that they publish are immensely helpful. So everything that Steve and Ashley said, the pitch book, the CB Insights, Crunchbase. Yeah. I think those are probably the big Carta, of course. They have unrivaled access to data. Data is good for decisions, as we all know. Any other questions before we start to round it out? Yeah.
Very early on, I asked a question. We haven't gotten to it yet. And
please. I apologize.
I was just asked, if you're a founder and you're looking at bootstrapping versus a pre-seed round, what are the risks to your valuation or eventually getting capital to doing one or the other?
Absolutely. Got a little bit of an answer. Steve, Ashley, thinking?
Yeah, I mean, I think it's generally positive. If you have the ability to bootstrap, it'll benefit you down the line. So if you can get yourself through, because, right, I mean, one of the big things investors are doing is trying to de-risk themselves. So if you can take on that early risk and prove you can build a product, prove you can get a customer, whatever those important marks are, you've de-risked the investment for the investor. And so that'll naturally benefit your valuation. So I think to the extent you can bootstrap, that's amazing, and you should do it. It'll help your valuation down the line. I met with a founder of another company a couple weeks ago who had bootstrapped it. He was having a hard time raising capital. It sounded like this guy was pretty wealthy, and so I think the investors saw through, like, why are we going to give this guy money? So if you're super rich, don't expect too much capital down the line. Anyway, I think generally speaking, it's a good idea to bootstrap.
Yeah, and I'll also agree with Steve's points. I'll also add that I can recall conversations with several investors who, and this was more of a conversation with like the mid-level folks, like the principals, not necessarily the partners, but those are the ones that are kind of really making the first round of screens happen before they go to the decision maker of the fund team. And there was definitely a pattern of, in a perfect world, this business is a $100 million revenue business in 5 years, and that's something that probably a lot of us in this room have heard before. And if you're bootstrapping for the first 1, 2, 3, 5 years of that business's journey, of course you're extending the timeline, and maybe it's not a $100 million revenue business in the first 5 years of the business's existence. Which is perfectly fine. I think I remember reading an article that says, like, here are the businesses that bootstrapped at the beginning that are the unicorns of today. It's probably important in that scenario to, when you're having a conversation with a prospective investor, just maybe explain, as you're kind of telling like the narrative version of your company's history, it was an intentional choice for this period of time to be a bootstrap business, and to get to a point where we were on solid footing and a cash flow positive business, and start things off from a position of strength. Maybe the market we were going after needed time to develop, or we were putting out a product that's so novel that we really needed time to kind of be a category creator and create a market for ourselves. I would just control the narrative, I guess, is the short version of the response. Yeah, because there's just so many of those investors, especially the ones that are doing the sourcing and the vetting, the associates, the senior associates, the principals. I'm looking for a 5-year, $100 million business, 5-year, $100 million business. If I see anything outside of that, if they haven't made it happen in 2-3 years, I can assume they're never going to make it happen. And it's, a lot of us are going to roll our eyes at, at the character, at the persona that I just put out there. But it's sort of the reality. So I would just say, control the narrative to the degree that you're able, and just explain this was a conscious choice that we made for the start of our business's lifetime, and here's why, and now here's the plan for the future. 5 minutes to go. Questions? Yes.
Thanks. I know you said you aren't going to get into some of the calculating different valuations, but I didn't know if you could just touch on it. So when you think about multipliers of revenue or potential revenue or ARR, and I know there's different things that go into that, and sometimes it's totally potential, right? It's totally made up, so you're telling a story, and then you multiply it anyway, and there's an equation. So if you all could kind of touch on that a little bit and maybe give some kind of executive summary key takeaways for people, I think that would be helpful for just different people.
Absolutely.
Yeah,
We're here to talk about valuations after all. Steve, not to put you on the spot, but to put you on the spot, are there kind of some basics that you learned in your raising history? And if we shouldn't disclose too much about Monet's fundraising narrative over the years, that's okay too, and I can shoulder the load a little bit better.
Yeah, I mean, so there's definitely multiples. I think you can look at all the resources that we talked about earlier. You talk to investors, they all, and it's different by fintech, health tech, whatever. The caveat I would give on all of those multiples, again, the further you go back down in early stage, those things hold up a little bit less, because those multiples are derived off of transactions that are happening, either in public markets or in, growth equity type transactions. And so, my perspective, it's hard to extrapolate those multiples further and further down, because in theory, those companies are, while they have that revenue, they're at lower growth rates than, maybe an early stage company would be. So it's a combination of multiples, growth rates, potential, all this other stuff. That's why it's like, to my point earlier, it's a little bit more about the story as you go further down. So there are multiples out there. It's a starting point. It's an easy thing to put into an Excel sheet and everyone sort of talk about it. But I would just be careful about anchoring yourselves too hard or too stringently, to those multiples, and talk more about potential, more about growth rate, more about kind of where the business is going, as opposed to some number that actually may not be super relevant to the stage company that you're at.
And to build on that, if you're having prospective investor conversations, one more poll for the audience. Raise your hand if you're a first-time founder. Raise your hand if you've done it before. Raising capital. Okay. So apologies to the repeat founders in the room. And please correct me if you think we're giving the wrong kind of advice. But for the first-time founders in the room, if you're having conversations with prospective, they might be angel investors, and they might have a long history of doing it. They might be institutional investors. They're going to be sussing out. Does this founder know what they don't know? Is there a certain level of naivete in there? If there is, are they going to seek out sage advice if they need it? And trying to figure out on the spot how deep to go down the rabbit hole. You know what? Pause that point. Sorry, because I think we're coming up on time. 2 minutes. We're not even gonna have time to finish the point. Let's wrap up with final question.
Just a statement.
Yeah.
I think you hit on a lot of important points, but I think that authenticity, that passion, and even if you have glaring gaps that you're able to fill with additional subject matter experts that you build around yourself.
Absolutely. I will put a huge +1 on that point, especially if you're a first-time founder. If you can demonstrate to the investor that you've got more of a team than the FTEs or the co-founders that you have key advisors who can make sure that even though you haven't built a $100 million revenue business before, you're surrounded with folks who are bought in and have done it before. That's a great way to de-risk the team component of your business. One more?
I've been asked this before, and I think it would be helpful for the first-time founders. When do you have to do a 409A? How early, like you're talking about down the funnel, when do you have to think about doing that?
Can I turn it over to Celine? Celine, do you-
Well, we're both.
I just spotted a friend in the audience.
We're colleagues.
You're right.
I don't know the answer to that question. Not sure.
Yeah, I'm not a tax person.
Going across the room, anyone know that they know the answer to that question? Yes.
If you have an option pool, for example, and you need to price your options and your employees are like, how much are my options worth? It's a talent-driven thing. So as late as you need to put off the expense, but as early as you need to keep people feeling like they're engaged and they understand what the value of their options are in the pool.
Thank you. A round of applause for the audience. So I think that's it. Should we give key nuggets to wrap up, or we're at time?
You can wrap up. I'll let it slide.
All right. To leave the audience with one key nugget, Ashley, and then Steve, and then I'll take one.
Timing is everything and nothing.
Great. Steve.
Yeah, just on the last exchange, I think the point about humility and transparency with investors is really important, both during the process when you're kind of feeling each other out, and then once you have an investor, maintaining that transparency and humility and honesty, like, people talk about it as a marriage, whatever it effectively is. So I couldn't agree more with that. It'll benefit you in many ways.
Probably still a hot take, but if you are early stage, you're pre-seed, just stay in the comp bands. There's really not much of a reason to go outside of it. Focus on good fundamentals and building a business that you're very confident will be successful in the future, and get good at telling that story. Valuations deserve a lot more of your headspace later on at later stages of your business's journey. That is it.
Awesome. Let's give him a round of applause. And just to piggyback off that, this Friday for the early startups, early founders, there will be an opportunity to share your venture at the Startup Boston Week closing party. Check out the Startup Showcase open mic information at the welcome desk in the front lobby. And before you leave, again, thank you so much for being here. Thank you for your time. We do have a lot more in store for all of you guys. And we just want to thank Suffolk University for giving us this space, for hosting us. We also do have a welcome party presented by HPE right here at 6 p.m. And lastly, the next session will be in this room at 1:15, and it's from the Code to Company, the Technical Founder's Journey. If that's not your vibe, which is perfectly fine, our team at the front desk will get you situated and point you in the right direction. If you are sticking around, though, please have your QR codes out, and someone from our team will come around and scan them. Again, thank you. And connect with these individuals. Don't let them slide. Ask your questions.
Thank you.
Thank you.